Hello, LinkedIn Live. Thank you for joining us for another session of Startup Series Live, coming to you today from New York City with my good friend, Paul Setti, and excited to be with you today. So, Paul, thanks for joining.
Thank you for coming. Thank you for coming to New York just to see me.
Oh, absolutely, man. I love seeing you. So, we have a series here called Startup Series Live. It's on LinkedIn Live, which is a pretty new platform. And the whole goal with it is to try to build a community for entrepreneurs as well as investors and other folks, even service folks, folks who service the industry, kind of like a community where people can share insights, learnings, hardships that they faced as an entrepreneur, as an investor. And so one of my goals has been to bring in some great guests like yourselves who are experts in the field. I'm pretty lucky to have, an access to some people who've done amazing things, both as entrepreneurs, investors, and even in and around the industry, lawyers and wealth managers. And so today I'm really excited to be bringing you on, who's someone I've known for a long time, but have also seen how your career has just kind of skyrocketed over the last decade. So let me tell you a little bit about Paul. He'll be more humble than I will be with talking about him. So he is the managing partner of a new fund, 2048 Ventures. Just closed on this fund, I think, in the last month or two. So very exciting. He's been an angel investor, though, for 12 years, and he's invested in some phenomenal companies: Flexport, SeatGeek, Knotel, LearnVest, and Transfix, to name a few. He's also an advisor to OpenFortune and Transfix, and he's also been an operator as well. So he's an entrepreneur himself. He was the former CEO of Redbooks, which was acquired last year. And he also is the co-founder of Robuzz. So what's really exciting about Paul, and something I've really admired, he's been both a great investor, but he's an entrepreneur and an operator. So I think it gives him that level of credibility because he's been through the journey. So Paul, again, thanks for joining. And anything you want to add to your bio?
No, excited to be here. Thank you for sharing that.
Yeah, and this is your first LinkedIn Live?
First LinkedIn Live.
Awesome. Well, I hope it won't be your last. I hope you do more after
Absolutely.
This. So Paul, the first set of questions, and again, this is for entrepreneurs and founders maybe who want to be thinking about building their business and building it in the best possible way they can. Maybe you can start talking a little bit about how you got into the investor game. So how did you become an angel investor? What's the background there?
Yeah, so early in my career, I was actually an investor in public companies. I was pretty fortunate post 9/11, whereas I thought I was actually going to be out of a job for a while. Ended up landing from a banking job where I got laid off into a hedge fund job when the hedge fund world wasn't really that sexy.
Right.
So we were investing in small microcap companies at the time, and I ended up having my focus being on the tech side. And I was in the fortunate position being very young, but being able to actually step up and spend meaningful amounts of time with senior leaders in these public companies. So with the CEOs, the CFOs, and really diving into these hidden gems in the public markets that people just weren't paying attention to. So I got an opportunity because of where the firm I was with and these individuals coming to pitch us because nobody else was paying attention to them as these CEOs, CFOs. And so I started understanding what it meant to be an investor, period, full stop, and what it meant to actually dive in and really try to understand what really makes these companies tick. What I ultimately realized was that for public companies, you don't really have any control over what's going to ultimately happen. And we actually did try to help them get funded. So even for these public companies, get them capital on their balance sheets to get them from point A to point B to point C. But even then, Mr. Market's Mr. Market. I then just by happenstance got into angel investing. A few friends were starting companies, and I ended up spending a little bit of time with them. And one of the very first ones was one of my very close friends today, Danny Moon of UpNext, and he was starting a company. And I just saw how he and his three co-founders, they all went to high school together, how dedicated they were to what they were building, how passionate they were about what they were building. And I asked him a couple of times to invest. And initially, because of our friendship, I don't think he wanted to have an investor, but ultimately took me on as an investor. And I was fortunate to be part of that journey as the very first and one of the only investors for a long period of time. And then some institutions came in. But from that interaction with Danny, I got kind of more of that itch to keep wanting to invest more and spend more time with entrepreneurs. And whether or not I was actually having an impact with them, I felt like I was helping them get from point 0 to point A to point B. And really, the entrepreneurs are doing 110% of the work. As investors, you're really not doing much. But just seeing that success and seeing the impact that they have and that some of that capital and that hard work that they put in really having a meaningful impact on the outcomes versus in the public markets that not existing, that got me very excited.
And in your first investment, that was 2006, was it?
2006, 2007, right around then,
So, after doing that first investment, why did you commit to early stage companies? What about early stage excited you?
I think it really is just the ability to spend time with entrepreneurs and having that feeling again. I'm not saying that it's actually really a contributing factor in their success, but having that feeling that you're part of their success, that you're writing the check, you're spending time with them as they need and trying not to interfere as much as possible because they know what they're doing and you want to be out of the way as much as possible as well. But having that feeling of being able to make an impact and being part of that journey makes you feel like wanting to do it more and more.
Well, and also, having early believers can really propel you as an entrepreneur, right? Because, early on, you get a lot of no's along the journey, more no's than yeses, but those first yeses can be really powerful, I think, for your confidence to drive it forward.
Has a snowball effect.
Absolutely. Absolutely. So now that you've been doing this for 12 years and obviously you have a fund, but can you synthesize any of your key learnings across the portfolio?
It's all about the people. So every time I look back at both my portfolio and the anti-portfolio, the decisions I made right to invest, the decisions I make wrong to invest, it's about the founding team, which could be either sole founders or co-founders, and what they're doing very early on that leads any one of us to believe that they could actually be that special one to disrupt a market. Now, they have to prove that they have a market. That there's a market to disrupt, that they have a product that they've been able to either build or prove that they've done something to that point that will allow them to uniquely play either in that market or uniquely execute in a particular vertical, because you need to really understand what makes them them. But there's so many personality traits that I think just over a period of time with pattern recognition, I think I've probably looked at 4,000 plus companies over a 12-year period to make approximately 100 investments. And so that just means spending that much time with founding teams and digging in and looking at that many companies and decks and everything that goes along in that very early stage. It all ties back to the individual. You can't invest in, there could be an incredible product and an incredible market, but if it's the wrong team,
they're not going to get it.
It's not going to work. If they also at the same time again need to have that product and market, but then the only thing you know for sure is they put a plan in front of you. It's not that plan that they're going to execute on, but they have the makeup to actually execute and walk through walls and make it happen.
And you've probably seen, of those, investments that you've made, how many have pivoted along the way, and how does that speak to the founding team? I'd say
the 10 most successful companies in the portfolio, I'd say it's probably 7 or 8. Not pivoted. I wouldn't say they've hard pivoted, but they've bobbed and weaved.
100%.
And there are probably 2 that have said, all right, day one, this is my plan. And that's the plan that they've stuck to all the way through.
Really interesting. Well, it's we hear this over and over again that it really comes down to the team at the end of the day. Certainly you have to have product and market fit and a market that's sizable, but a good team will be able to navigate that.
That's right.
That better than others. So congratulations on your new fund, 2048 Ventures.
Thank you. Now we need to responsibly invest that capital.
Yes, which you started with your friend and co-founder Alex Iskold, correct?
Yes.
Tell us about the new fund.
Yes. So we're very focused on investing at the earliest stage. So we want to be the very first institutional check. So there could be some friends and family capital in these companies, but we want to invest in tech differentiated founders. So there should typically be a technical founder on that team. We want to invest in markets that we believe have or are ripe for disruption, have either experienced some disruption recently or are ripe for that. We're investing in a geo-agnostic manner. So that means, with the exception of the Valley, which we feel like is entirely overheated, we're investing in every other North American geography. So right now we're limiting it to US and Canada, with particular interests in Austin, Toronto, Waterloo, Atlanta, where we've already made an investment. And in fact, Toronto, we've already made an investment as well. New York and Boston, we have very deep ties here. And then we're also looking at Nashville, Seattle, Denver, we've made an investment already, Minneapolis. But there are a few cities where we believe that talent exists and capital is very lazy. So capital is not necessarily going there, and we're ready to go there.
So there's kind of an opportunity to find those gems that, investors who are in those other markets aren't necessarily going to find.
That's right. And then we're looking for particular characteristics within those founders as well that we invest in.
So very interesting. And so tell us, why did you launch this fund?
So I think it's really been the culmination of the operating experience I've had And then even more so, the investing experience over the past 12 years, and realizing that it's at that intersection of the operational experience and the investing, that if we invest at this stage, we could actually have some of that interaction where, again, we're not operating, we're not co-founders, but we want to be similar to founding investors, where at the earliest stage, we want to be there to augment the superpowers that we believe the founders have when we invest in them. And so that could take different forms. So if they're slightly weaker on the customer acquisition side, we could dive in and go deep there, and also bring our networks around there. If for some reason they need help on the UI UX side, either we'll help them ourselves, but more than likely we'll pull in particular individuals from the network that have been very strong on the UI UX side. On the fundraising side, we've created a very interesting group of LPs, and it's a very unique makeup relative to other funds. So our fund is made up of investors that are 50 plus very successful founders, 20 or so very successful founding venture capitalists, and then a whole host of other executives across verticals as well.
So are these investors that ultimately, could write be part of the next round of funding, or how would that work?
That's a good question. So the founders who have invested in the fund as LPs, they could actually, in some cases, invest alongside us because they have particular verticals that they're interested in. They're less likely probably to follow us, but in some cases they'll want to invest later. So we'll invest first check, pre-seed, founding investor, whatever you want to call it. They'll tend to invest a little bit later, so they could certainly invest in the seed stage, probably not lead that seed, but be another angel check in that seed. And then obviously the VCs that have invested, in part, it's because of the relationship that Alex and I have had with some of those VCs in particular. And in some cases, absolutely, they want to see the deal flow from us and want to see it early.
No, it's exciting. And so how will you leverage your experience in the past with this fund? Like, what are kind of some key things you'll bring to the table that you'll be able to leverage to do better maybe than the average institutional fund?
Yeah, it's a great question. So I think it comes down to, and I don't think it's the best answer, but I think that pattern recognition has a lot to do with it. So you're an operator, you're an entrepreneur, a founder. I was an operator for 7.5, 8 years. So being able to call BS early on makes a big difference. So being able to actually identify and sift through the real signal from the noise, and there's a lot of noise out there, unfortunately. So being able to identify the truly extraordinary founders, and potentially, although I don't want to take a lot of credit for this, but the products that can disrupt in the market. I think that one is tougher, but identifying the founders I think is easier, because you could have that operator to operator conversation with them. And then because of the sheer number of companies, my partner Alex invested in 100 companies as managing director of the flagship Techstars New York program over a period of 5 years. And I've invested in an equal 100 companies, but over a much longer period of time. But just the access that affords us in terms of deal flow, sheer deal flow, and quality deal flow. So we're getting good signal from the relationships and the nodes and network that we've formed across New York, and now we're slowly and very intentionally trying to form those in other markets as well.
Super exciting. It feels like you're very much set up for success.
Thank you. We hope so.
And it seems like I think you've already made 5 investments.
That's right.
In a short amount of time. Anything you want to share about those investments, or?
I mean, I'll say the first 5 were made in 5 different geographies. So, and it wasn't by design, but we are geo-agnostic, and we're very clear on that now in terms of where we've actually invested. So we've invested in New York, in Toronto, Austin, Atlanta, Denver, and LA. And then there was one outlier, a 6th investment that we've made. The company flipped into a U.S. entity, but a Berlin-based company that flipped into a U.S. entity.
All right. Awesome. So let's talk a little bit about success factors. There might be some entrepreneurs watching here, maybe folks who might want to pitch you at some point. What are some of the patterns you've seen in successful businesses? You talked a lot about the team itself, but let's get past kind of, all right, the founding team and the product market fit. Product's great, market is ripe. When you get past that stage, what are some kind of key success factors? What's the pattern you've seen that these companies that really kind of start scaling? What are there like consistent themes or patterns with those folks?
Yeah, so a lot of it. Well, first, I'm going to touch upon the founders for a second, because there's an important piece in the founder makeup that we look for, and we wrote a blog post about it earlier this year as well. And we're looking for founders that have the drive, grit, hunger, resilience. We need to feel like they're coachable, And then we very importantly, and this is one of the reasons why we steer clear of Silicon Valley, we need to feel like they're capital efficient and can build in a capital efficient manner. And that's just unfortunately not something you could do in the Valley, just because talent is so expensive to acquire and to retain. And so that's kind of, table stakes day one, what we're looking for in terms of the founders. And then as we see them scaling and moving beyond this first stage, where we felt like they've had the greatest success is either if one of the founders themselves have come out of the industry that they're looking to disrupt in, or if they've touched that industry or functional role. So they don't necessarily actually have to have been in the industry, but if they've actually either served in the functional role or sold into this functional role or built product for a particular functional role or industry, that's where we've seen the greatest success. If they have some experience, knowledge, that's right. It makes a big difference. And now at the same time, you don't want them to have so much institutional knowledge that they're jaded by their past experience.
Or over rigid in kind of their creative approach. That's very interesting. Okay. And then, so the founders themselves, talk to me about how you actually get at whether they have that grit, whether they have that drive. Because I know there's been books written about this, and are there certain questions you ask or certain themes you look for to say, hey, this person's got the grit?
I can't answer. I can't tell you that.
No. Secret sauce, maybe secret sauce.
No, it's really, I can't tell you that there's a specific list of questions that we're asking to get at those characteristics. But I'll say Alex, myself, and the two investment team members that we have, we're asking questions in different manners to ultimately get to the fact, is this in their DNA? And so while we're collecting all the other diligence related to the company, the product, the market, the competitive landscape, their go-to-market strategy, their fundraising plan going forward, the underlying all of that, or the overarching theme above all of that, is, do they have the characteristics to execute on everything they're actually sharing with us today? Do you have any kind of thoughts around solo founders versus team-based founding or founding teams, which tend to perform better? I don't. So I don't think, I'm sure there's data out there that does tell us that one performs better than the other, but from my own experience, I don't. So they're trade-offs. So being a founder is lonely, as you've experienced yourself. So it can be a very lonely existence. So having a co-founder, you could say, is great. At the same time, having a co-founder is a marriage, and founders should not take that lightly. You're entering a marriage just as you're entering into a personal marriage, and it could be very difficult. And if you don't have experience having worked with that individual, it could be very tough early on. It could have the potential to blow up very early on, and that's a real risk. And it's a real risk for really any kind of partnership, but especially founding a company from the very base. So to answer your question, we've seen them both succeed. The sole founders, they need to just bring a lot more to the table. So you typically want founders that are complementary to one another. So that means ideally you have someone who's focused on the commercialization on the business side, and another one, in our case, we're ideally looking for a founder that's technical. So if you have both of those in one person, that's kind of the dream. And then they could build and assemble a team of complementary talent around them. But for us, we're really looking for that technical is important, but at the same time, technical plus commercial. It's
really good. And actually, I'm looking at my phone here, not because I'm not interested. It's clearly that I have a question that came in from Farseed Kazi, good buddy. And actually, he's an entrepreneur himself. He's building a very exciting business right now. And his question was, the next question was on my card here, which is, can you speak to some of the industries that you're particularly bullish on that you think are primed for disruption right now?
That's a good question. So we don't view it that way. So just as we're geo-agnostic, we're very industry agnostic and very founder focused. So when we meet with founders, and we're open to seeing founders that are building businesses, companies,
consumer, business.
So we're both enterprise and consumer. We'll invest in both, and we've already made investments in both sides. We feel like net will probably end up being 75-25 or 80-20, leaning toward the enterprise side. But that's yet to be seen. We're most interested in who the founder is, where she's built before, what she's done in terms of her experience prior to this point, why she's uniquely fit to disrupt again in the market that she's looking to disrupt in. That's the critically important piece for us.
Love it. So let's move to a little bit to the funding side. And there might be companies that are seeking capital as we speak, right? And they have some options between friends and family, angel type investing, probably be pretty low cost for them in terms of setup and structure versus institutional funding.
Yeah.
How do you recommend as both an investor and an operator yourself? How do you recommend an entrepreneur think about those funding options?
If you can afford to, bootstrap as long as you can.
Yep.
First and foremost, because the more you can prove, the more likely you are to accelerate yourself in that funding path.
Yep.
And so if that means taking some friends and family money, by all means. In most cases, the friends and family are likely not going to add significant amounts of value, and that's okay.
Yeah.
And that's fine. Early on, you actually just need capital, and you need, like you were mentioning earlier, you need that endorsement, that feeling that somebody is believing in you, and that's important as well. From our perspective, we'll invest as early as nobody else, and we'd love to be the only
pre-product or product.
We'll invest in some cases. We'll invest pre-product, and in most cases, we're looking for at least an MVP, or their proven ability to build an MVP. So one of the two. So if we feel very confident that they can build it, and it's we see that line of sight, it's going to be built, then we'll invest pre-product in the right team. But in most cases, when most cases we want to see an MVP. But in terms of the funding, we'll be the first funder in a company, the first institutional capital, and we're happy to have other strategic angels around the table as well. And in some cases, we'll bring those strategic angels with us, and in some cases, we'll also invest alongside other institutions. But it's really you take the most strategic capital you can get at the time you're looking to raise capital.
All right. Yeah. And you keep hearing this theme, team, founder. Like this is what really is important to Paul and team from an investment perspective. So are there some common reasons you've seen, in the 12 years that you've been investing, or 13 years now, I guess, are there some common themes or reasons why you've seen companies succeed and why companies have failed?
I think the ones that really succeed are they're self-aware.
Yep.
They're coachable and yet have very strong spines, and that's super important. So they don't want to just bend over or bend to the whims of particular investors or advisors, because you'll have so many different opinions coming from all directions.
Yep.
And we've seen founders unfortunately experience that kind of negative input and feedback, and then they're just executing in so many different directions. But the ones that really succeed, they're looking at, let me continue to improve month over month, quarter over quarter. They're at the same time, they are looking at the long-term vision, but they're very focused on that execution and what it means to continue building that team as they continue to scale, because that's super important as well. And you have to be able to, as a founder, and especially as we were talking about the sole founder versus co-founders earlier. If you're a sole founder, you need to learn how to delegate, because you're accustomed to having control over everything. And similarly, co-founders have the same thing. So you could have 2, 3, 4 co-founders, and they're accustomed to owning their domain. The ones that really succeed as they begin to move up, they hire incredibly well, which is difficult. And they're patient in their hiring. It's hire fast, fire faster. But more importantly, try to hire right, and then start delegating and empowering those individuals.
I couldn't agree more with that. That hiring piece is so critical, and talent's really challenging. It's really in tough. A lot of markets.
And then retaining talent, making sure you're fostering that talent, that you're really planning for their career growth.
And you mentioned earlier before we started that it's important to not be thinking about liquidity. Your exit. You can have a vision for where your business will go, but thinking about liquidity multiple times along the way can really, I think, get you off track.
You should be focused on the capital that you need to hit the operational milestones versus what does that operational milestone mean for me to ultimately have a liquidity event. The liquidity event will come. If you're building a high quality, high performing machine of a business, there will be strategic buyers, financial buyers. I mean, I don't want to say IPO markets because that's rare, but there will be liquidity event opportunities.
All right. Well, we're coming back to the last couple of questions here. So let's flip it now. You've given a lot of your vision for what you're looking for. On the flip side, what should these management teams be looking for and expect from their investors?
That's a great question. So it really depends on what they need. And so they should be making sure that the investors can actually fulfill the needs that they have from a network perspective, from a fundraising perspective, in terms of future fundraising down the line, Potentially, can they introduce them to other individuals that can be strategically helpful? Most importantly, I'd say they should be speaking to the portfolio founders that those investors have invested in before.
Yep.
Both the ones who have been successful, actually three, those who have been successful, those who are still operating today, and those who have failed. Because you'll learn a lot from the failed companies and what the interaction was like with the investor that you're considering taking capital from on the way out when some of those companies have failed. Because it's not because the founders have failed, it's not because the investors have failed, but that relationship and what's actually occurred from the time when the investor first funded to when the company folded is a telling one. And then, of course, you want to talk to the founders that are operating today and interacting day in and day out. Super helpful.
And then, you spoke obviously about the Valley being like an expensive place to build a company, and you're not looking there. Obviously, you have your network here in New York City and Boston. But what are some secondary and tertiary markets that you're excited about, and why? Yeah,
absolutely. So, and the other thing around SF, because it is very expensive to build a team and retain a team, it's also that raising capital is fairly easy. It's not entirely sophisticated, but they're just founders. There's so many founders that have been successful. You could pass the hat around in SF and complete around.
I'm going to interrupt you for 1 second, because I was up there last week, and I was up there the previous month in San Francisco, and it's the only place in the country, let alone the world, where I get asked out of nowhere, so who are your venture backers?
Right.
It's like, well, we never took venture. What do you mean? Like, it's a bizarre foreign concept there.
It's anathema to their what is going on?
It's so interesting. So anyway.
So the secondary and tertiary markets that we're interested in are the ones where we believe there is technical talent. And so Austin, perfect example. Toronto, Waterloo, great example. Atlanta has companies that are forming, that are growing and are becoming very, and Georgia Tech adds to that as well. The universities absolutely add to this. And then when you see successful companies starting to spawn off micro teams, so there'll be a couple of team members that work together in a company
that exited or interesting.
That's right. So so the cities that have the university talent, like you're talking about, and then if they could if that city marries itself with founding talent that's coming out of companies where they had operational experience and that marital, I guess that premarital working experience together. So those founders could actually marry themselves and come together. That's super valuable.
And those are all really cool places to live: Atlanta, Austin, Toronto.
And that's right. So now you'll see talent. That's the other point. You'll see talent coming from the Valley and saying the quality of life, the cost of living is much more reasonable in Atlanta, in Austin, maybe not Toronto, Waterloo. They might want to stay in the US, but some of these other cities, and they'll say, let's move there and let's build our team and company there. And at the very least, they'll build their second, whether it's, the second office they'll have in one of these cities, and then you'll see talent come from there as well.
And the barbecue and beer is better.
That's right.
So, cool. Well, I think that's all the time we have for today. I think we're really lucky to have Paul Sethi join us here for a session of Startup Series Live. We're coming to you live from his office in New York City, where he just launched 2048 Ventures. He's been an investor for 12 years, but he launched his institutional fund, I think in May it officially closed.
We closed it in May, $27.5 million fund one.
That's amazing. And it's 5 investments already. And Paul, if anyone wants to reach out to you to share a bit about their business, where do they reach you?
It's psethi@2048.vc.
Guy's one of the best in the business. He's been an operator and an investor, and he's picked some winners and has built some great companies. So he's also just a great person, and I think that's really important from the guys you work with. So Paul, thanks so much for taking the time today.
Thank you very much. Really appreciate it.
And I hope you enjoyed your first LinkedIn Live.
This is fantastic.
Cool. We'll see you again maybe later this week as we have more conversations in Startup Series Live and also talking to LinkedIn Live influencers. So thanks for joining today, and we'll see you next one.